It's Brian Shannon here from Alpha Trends. Today is Wednesday, the 25th of January, 2017. And as we've been saying, this consolidation that's been occurring through time was most likely to resolve in the direction of the primary trend, which was higher. And of course, that's what we have here. The market has broken out. It should not be a surprise when the market breaks out after a period of tight consolidation like we've seen here. It would have been more surprising if the market broke down. But as we know, the market has been kind of neutral the last couple weeks as it's been trading between in that band of support that I just drew in and this band of resistance, which was just overtaken. We are, of course, above the volume weighted average price year to date and that rising 5-day moving average. The buyers are in control, and there shouldn't be anything to worry about as long as this market remains above 227 and a quarter to 227.50. Any pullbacks down towards that level would be viewed as a test of prior resistance, which we would expect to become support. But of course, we would be cautious in that area and not just buy a pullback to that level blindly. As I mentioned for subscribers today, the ideal scenario for today would have been a pullback and then a rally. But as I also mentioned, that we often don't get what we want, and instead be prepared that if the market gaps higher, it's most likely to be able to continue to move higher. So here we are at all-time highs once again for the S&P 500, and the Nasdaq continues to show short sellers that shorting an uptrend is just an absolutely foolish thing to do. Nobody knows how high the market will go, and our job is not necessarily to look for upside objectives, but instead our job is to manage risk. Once you're in a position and it's moving in the direction that you want it to, you manage risk. And if it doesn't move in the direction that you anticipated, you get stopped out with small loss and look to reestablish at a more appropriate time in the future. But obviously, the Nasdaq continues to move higher, and I think that similar to the band of resistance that was broken in the SPY, we've got a good distance between us now and where the volume weighted average price. I mean, for the week, we could say possibly if we test that at 124, that wouldn't be a bad thing. So a pullback to 124 might seem like a big deal, but it would only be a big deal if you're a day trader. The Russell 2000, this market did the same thing as well. It broke beyond that resistance, and this is what we were looking for, the ideal scenario in the Russell yesterday. But as I mentioned to subscribers, what happened here, we got down to and through that 50-day moving average. The 50-day moving average was declining. The market came down very hesitatingly to that and through the 50-day moving average, and we are back in control by the buyers. Now, it's a little bit sloppier here still in the Russell 2000. If you look at this intraday time frame, this has kind of been the descending range that it's been in. So I think that ideally right now for the Russell 2000 that we'd like to see it pull back down towards 136, maybe 136 and a quarter. If it were to do that, it would help build energy for continued upside. But right now, you can't just sit around waiting for a pullback because the momentum is higher. You have to say, if I buy it, let's say tomorrow, your idea is I want to buy strength on a breakout. Well, you have to say, where would your stop go? What's acceptable to you for a fresh breakout tomorrow? Would it be below today's low? Would it be below the volume weighted average price for the last 2 days, or maybe the volume weighted average price for the week? That's up to you to decide. But the fact is, the buyers are back in control of the Russell 2000. They remain in control of the semiconductors. This group has ruined more short sellers than any other group over the last year or so, as it just continues to trudge higher. We've got a rising 50, 100, 150, and 200-day moving average, and those are not hallmarks of a bear market. That is a good, strong, positive uptrend with higher highs and higher lows. We broke above this band of resistance yesterday, and if we're to pull back down towards 74 and a quarter, it would be bad for the people who bought up here, at 75.51, but it would be a healthy pullback that, if held as support, would rebuild for continued upside. But right now, again, we can't be waiting for pullbacks. You have to look at the low risk, high probability stocks and get them as the momentum begins to move higher. Now, the biotechs continue to be just a disaster here. You can see that purple line is the volume weighted average price from the beginning of last year. We're still stuck below that. We're below the volume weighted average price for this year. We are up slightly for the year, but we've been stuck under that 5-day moving average here for the last couple weeks, and we are also, of course, stuck below the year-to-date volume weighted average price. Now, today we got back above the 5-day moving average, so maybe it's going to start to neutralize in here a little bit. But again, the average price paid for the biotechs this year is right up near where this prior little resistance area is. So even getting up to that level, I mean, it'd be good for a very short-term trader, but with the primary trend still heading lower with declining 50, 100, 150, and 200-day moving averages, there's just no advantage to be trading a group like that. We did see that NVIDIA is showing some further stability here. It gapped up today, pulled back, but held above the 2-day VWAP. And what we've been mentioning in here was the volume weighted average price from this gap higher, and that had been acting as resistance. Now that resistance seems to be holding as support, and it looks like the buyers are again back in control of the intermediate term trend in NVIDIA. And if it were to break below today's low, then maybe you would want to reassess that a long position there.